Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 4 o'clock in New York on Wednesday, March 26, 2014. And this is the daily report for gold and silver. We have a continuation as gold really breaks below a critical band of support, roughly at around 1310, trading roughly at 1303, putting it off about $6 on the day. Now it has broken just briefly through 1300, low 1298.90, the high 1318.20. Silver also under significant pressure, actually trading off more than 1% on the day, low 1962, high 2026. More on silver at the end of the show. Traders, if you recall from yesterday's show, we mentioned the fact that gold prices were absolutely flirting in this particular area, 1310, 1313. You can really see this kind of band of sideways trading activity. And my sense was, and I believe my statement was, that if we can't see some effective closes above this 50% retracement, call it 1310 to 1313, it really has nowhere to go but lower and probably go to threaten the 61% level, and that's at around 1282. Now, we haven't really touched down that low. Our low today, I believe, was around 98. You can see it has recouped a little bit. We're looking at a 320-minute chart in standard candlestick format. And when we go ahead and blow that up, what we notice is that we've got some very, very strong, whether it's short covering or bargain hunting, that came into the market once the market actually broke below 1300, and that would be this band right in here. It did it. Let's try to put it in as straight as possible. It did it ever so briefly, and you can see that it is now absolutely trading higher than these recent lows, but not by much. Now, does that mean that we might see some support come into the market? My sense is that we don't really have any technical evidence to back that up. And in fact, when we look historically to find areas in which historically the market has reacted in certain ways, we really have to span through time, because the market has genuinely not been in this area for quite some time. And this is what I mean. All I've done is really compress the chart so we can show a little bit more data. We're going back to really October, November of last year. We had two rises in the market, one going to 1435, the other one going to 1365, 1360. You can see that right here. That's this particular top. But if we basically put in a horizontal line, and what the horizontal line is going to do for us, when we're going to peg it to this low right in here, it's going to show us, historically speaking, what the market has done in this point. And as you'll see, short term, we don't really get a lot of data or information, because the last time this market was at this particular price point, it was literally on a fall from grace. There's nowhere really that we can see any kind of supportive action. The market comes down, touches this for a point, trades up, and then breaks through there. But there's really no, in my opinion, genuine technical information that can be gleaned by looking historically back as recently as last year. Now, all I've done, I've gone ahead and pulled up our daily chart. This has a number of different fib retracement levels. In essence, the way I created this chart, just a little FYI, is we use different bottoms always going to the record top. So that bottom there, this, and so that's how we created these different levels in terms of our Fibonacci retracement. Now, when we do that, the only thing that's really in this area is this 1295. And we also come up with that number from our short-term work. And you can see that right in here if we go ahead and blow this chart up. In terms of short-term work, we have 1311 right in here. Let's go ahead and darken this up a little bit. And all I've done is I have darkened some of this fib retracement so we can read it a little better. And I have added our secondary fib retracement. So we have two retracements, one from here and one from this particular bottom here. And the reason that I do that is that you can see that as this market moves up, it hits this peak and then comes back down. So we definitely have a subwave right in there. And so those are two valid points. And when we look at this, 1293 is the closest thing that we can come to. It's a 61% retracement of the move from 1233 to 1360. So we really are looking at a scenario between, say, 1293 and about 1287. I believe that's what this 50% is right here. So we have this band in which we should be able to find some support if the market continues under pressure. And my sense right now is that there is that opportunity. Now, the one caveat, of course, is the fact whenever you hit these century marks, 1200, 13, 1400 per ounce, there is a psychological level of support and resistance there. And so we are seeing the market move up off of those lows after dipping below 1300, but we really don't have any verdict and absolutely have no technical evidence that we're kind of have weathered this correction. If anything, we could be at the tail end of it, but we don't yet have the kind of information we need to make a good, solid technical call. And traders, I've gone ahead and pulled up, this is a daily chart. It is the continuous contract of COMEX. And when we look at the different levels, of course, they're going to be very similar, if not the same. But we talked about this before. We have a very minor level, this level at 1296, the low 1298. So we have effectively touched to the bottom of that. You can see it's trading off that. Still on a daily chart, we've got a down day. So we are looking at a red candle. And then we have I believe, a much stronger level because this is the 50% retracement of the entire rally, and that falls in roughly at, call it 1290. So my sense is this: we had a $200 move. From that $200 move, we're going to give back roughly 50%, and then from there we should move back into our next impulse wave. Now, as I talked about, the exciting thing about where we are within the marketplace is if we can correctly time any kind of potential bottom that we have and effectively catch the pivot point or beginning of this up wave, the fact that we are going into a wave 3 count is important because basic Elliott wave theory states that wave 3 cannot be the shortest of any of the impulse waves. That being said, we had a $200 move here. Let's say we get a $100 correction here. We're probably going to get a 200 move to the upside. Now, assuming that the market bottoms even at the low end at 1268, that's a 61% retracement. The 1274, that's a 76% retracement of the shorter of these two Fibonacci retracement levels. But wherever it falls and bottoms within the confines of these lows right in here, because I believe that this is going to be our potential target anywhere between where we're at now, a couple of dollars lower, all the way to as low as maybe 1274. On the low side would be a 61% retracement of the entire move. And I'm not really looking for the market to track that low yet. But when we look at that, the one thing that we can see is that we have these series of tops right in here. So we had an area that has provided resistance before. And remember, one man's ceiling is another man's floor. So the fact that we had resistance that pops through, it comes back down. We could easily see support in this area too, and we've got some good historical data points that kind of back that up. But what I believe is the most important part of that is wherever that falls, whether we've seen the bottom and just don't know it yet, or we have a couple more dollars to go, we should have a wave that's going to provide us with enough room that we can get in too late, get out too early, and still take anywhere between 40 and 60% of that move. If that move is in fact a $200 move, 40% is an $80 trade. So that's what gets me excited. That's what keeps me going in the market when I see this kind of activity in the market, because I realize that what we're looking at is really a setup for our next trade, and it could be a really, really spectacular move in the market if, in fact, we do see some sort of a impulse wave, a wave number 3. Now, another way to look at potential bottoms in the market and to ascertain whether or not we might have already, in fact, seen a bottom, I've put up our cascading channel lines that we do with our Andrews pitchfork. Obviously, I've blown this up to great detail because what I'm looking for is at what point this next level, this next prong would actually get crossed. And it happens just below 1280 at about 1278. And then, of course, when we go ahead and look at that particular price point, the 50% we identified 1289, 76 was 1274. So that would be really the lowest I think it would go if, in fact, it hasn't found some sort of support here by virtue of that century mark. And as I said, on a technical basis, there's really no evidence that can support that because we don't have really a lot of moves at that particular data point. And if we go ahead, let's go ahead and kind of compress this back so you can see what we were looking at. Kind of compress this down this way. And now you get a better idea. What I'm talking about really is the fact that this channel line obviously seems to still be in play. And typically when the market moves, it will genuinely fall to one of these particular lines and then move back up off of that line. And so that's the reason that I'm actually looking at this as a potential area for the market to move to. And of course, you have to go ahead then and scale that to really get an idea of where that falls in, because it does fall with time. And so that's where I'm deriving those bottom numbers from, and that's the technical evidence that I'm using that's giving us at least a sense that this should be the bottom if it does continue to fall. Of course, when we stand back, and this is a weekly chart, my sense, of course, is that what we have witnessed, this is the beginning of our major fifth right here, or the conclusion of our major fourth here. And what I'm looking at, we've identified where the market stalled at. And when we look at the weekly chart, of course, they're going to lag definitively behind anything that we do, but that's showing that we are in a full-blown sell right now. Actually, you've just gotten this week is the confirming candle to the engulfing bearish pattern that was formed at the end of last week. And then when we look at something even further out in time, like a 2-week chart, let's go ahead and pull that up. That's just beginning to show the weakness in the market, especially Japanese average. A 2 weeks is going to really lag in terms of the filter that we're using. Japanese average is going to lag even more. And if we go and convert it back to a standard candlestick chart, and we do that by removing this as a study, what you will see is this really shooting star-like candle that formed at the top. These green candles come up. Now you've got a real small candle there. Let's see if we can't just blow that up a little bit. Maybe thin this out just a little bit. But when we look at this 2-week chart, you can see market comes up. You do get a star type candle here. Then you get this shooting star and then the red candle. So that's still giving us a bearish tendency in terms of the long-term view. So my sense right now is that the best move we could possibly have is to be sidelined and to await our next signal. So what about silver? Hopefully, and I've gotten emails confirming this, most of our silver traders exited that silver trade when I recommended that you just take that stop to the market. And that's when we got stopped out of gold. I felt that without gold moving up, we don't have that impetus to see silver kind of follow in suit, and it tends to outperform in terms of percentage losses when the market's under pressure. Silver does, at least. The fact that when we look at this long-standing resistance line in silver, and that it was unable to breach that beginning of the year as gold really came in and made new first a 3-month, 4-month, then up to, I believe, a 6-month high on the market. What we saw was really a return to real resistance, and in terms of support, we've identified 1958 as a pretty critical area. You do have some areas just below it, but you can see that without a question of a doubt, for the better part of, call it 2013, these lower bands, meaning the low 1900s, 1921, maybe the high 1800s, depending on where this comes in at. No, it really wouldn't have touched it, but the low $19 per ounce, those are in 1920, 1910, those were very, very supportive areas. 1958 absolutely being a supportive area. We can see the market has genuinely moved to this area and for the time being has traded off of it. My sense is that this is almost a line in the sand, and then this is the absolute line in the sand, these series of lows that come in just below that. But a move below that would really be a bearish signal, and I think that we should see some support in silver between, call it 1920 and 1958. Market is now trading effectively above 58 at 1971. This has been Gary Wagner, wishing you as always good trading. Talk to you tomorrow for another daily update and review. Bye-bye.